You think you are diversified. You think your 401k is safe. But right now, 35 cents of every dollar you put into the S&P 500 is flowing into just 7 companies, and almost all of them are betting everything on artificial intelligence. Here is what nobody is telling you. If the AI bubble bursts, your diversified index fund portfolio could take a hit that takes over a decade to recover from. And the math on this has already happened before. Let me start with the number that should genuinely alarm you. The 10 largest stocks in the S&P 500 now account for 41% of the entire index's market capitalization. At the peak of the dot-com bubble in 2000, that number was 27%. We are 14 percentage points more concentrated today than we were at the top of the most famous tech bubble in history. Here is the math in real terms. You put $10,000 into VOO, the most popular S&P 500 ETF. Roughly 4,100 of that flows into just 10 companies, and about 3,500 goes specifically into NVIDIA, Apple, Microsoft, Amazon, Meta, Alphabet, and Tesla. The remaining 6,500 gets spread across the other 493 companies. If the Magnificent Seven drops 50%, your diversified S&P 500 portfolio drops 17. 5% from those 7 stocks alone before the panic spreads to everything else. That is concentration with extra steps. And here is a feedback loop that almost nobody talks about. There are roughly 70 million active 401k participants in the United States. Every 2 weeks, automatically, regardless of what the market is doing, their paychecks flow into target date funds and S&P 500 index funds. Because index funds buy in proportion to market cap, every single contribution mechanically buys more NVIDIA, more Microsoft, more Apple. The bigger these companies get, the more money flows into them, and the bigger they get. It is a feedback loop baked into the structure of how Americans save for retirement. Now let us talk about the money being spent, because this is where the dot-com parallel becomes impossible to ignore. Google, Amazon, Microsoft, and Meta are collectively planning to spend $725 billion on AI capital expenditures in 2026. That is up 77% from last year's already record-breaking $410 billion. The dot-com bubble did not pop because of one big crash. It popped because of a series of earnings reports where the expected revenue just never showed up. The specific event risk in AI right now is what happens the quarter that Microsoft or Amazon signals they are pulling back AI capital spending because the returns are not materializing. We already got a preview. In January 2025, a Chinese AI startup called DeepSeek announced they had built a competitive AI model at a fraction of the compute cost that was assumed necessary. NVIDIA lost approximately $600 billion in market cap in a single trading session. The market recovered, but the structural risk did not go away. Here's the Cisco comparison. At its 2000 peak, Cisco was the most valuable company in the S&P 500. Its revenue kept growing after the bubble burst. The stock still fell 80%, and more than 25 years later has never revisited its peak. revenue growth does not protect a stock priced for perfection. In the dot-com crash, the companies that survived had three things in common: real revenue before the crash, and pricing power over customers. Amazon's stock fell 90%, but had $64 billion in real revenue in 1999. Over 50% of dot-com companies were completely gone by 2004. The equivalent in 2026 is straightforward. Companies with actual AI revenue today, like NVIDIA with 85% revenue growth, or Microsoft Azure AI with real cloud revenue, are structurally different from companies that added AI to their pitch deck and tripled their stock price. Now, there is a move that almost nobody in retail investing knows about. The S&P 500 Equal Weight Index, ticker RSP. It weights all 500 companies equally at 0. The Magnificent Seven represent only about 2% of this index, compared to 35% in the Standard Index. That is 18 times less exposure to AI concentration risk. In a scenario where the Mag 7 drops 50%, the standard S&P 500 falls roughly 25 to 35%, while the equal weight version falls roughly 10 to 15%. Most 401k participants do not even know this fund exists. After the dot-com bubble burst, the Nasdaq took 15 years to reclaim its March 2000 high. A 20-year-old who kept buying through the crash was eventually fine. The investor who panicked and sold at the bottom locked in a 78% loss permanently. So what do you actually do? If you hold standard market cap weighted index funds, you are heavily exposed to 7 AI stocks, whether you chose them or not. Equal weight index funds, bonds, international exposure. And above all, make sure you do not have to sell at the bottom, because the crash that comes gets survived by those who stay invested.